Welcome to my channel on everything real estate. I'm Sean Kelly, and this is chapter 18 on the North Carolina real estate exam prep. This chapter is on the federal taxation of home ownership and is one of the shortest chapters yet. Can we get it under 10 minutes? Let's find out. First off, hit the subscribe button below so you don't miss out on any of the upcoming videos. Also, smash that like button for the YouTube algorithm. And let's get into some taxes. When it comes to taxes, there are certain benefits for your typical homeowner and then a different set of benefits for your typical investor. I say benefits, but taxes are taxes. It's still another expense that you have to pay at the end of the day, but there are some really good write-offs or benefits. As an agent, you should understand these, but you should never really give accounting advice to your clients. That is for a CPA. So unless you're a CPA, you don't want to be held liable for giving false information. The deductibles you get to account for are interest and property taxes on your payments. Additionally, during your closing, you can write off your discount points that you pay and other lending costs. Therefore, the remaining things that you can't really write off are things like insurance, maintenance, and improvements, and mainly for your primary home. When selling a home, your gains are taxed. So for instance, if you buy a home for $100,000 and then sell it a couple years later for $150,000, without getting too specific yet, that $50,000 gain will be taxed, and it will be taxed quite heavily. To get a little deeper here, let's go through an example. So first, when going through this, we're going to want to add up all of the initial cost that was put into the property and then subtract that from the new value that we have minus any other cost. So say we buy a house for $200,000, there are $10,000 in closing cost. So our total upfront cost now is $210,000. So then we later sell the house for $300,000 and pay a $12,000 closing cost expense. Our total value now is $288,000, right? So we sell the house for $300,000 but had to pay another $12,000 for closing costs. So we now have $288,000. Well, we bought that house for $210,000 all out and now have $288,000. That is a $78,000 gain. That $78,000 now you get taxed on. Important rules to know here, and not just for being a broker, but if you are a homeowner or plan on being a homeowner. If you live in a property, like your primary residence, for 2 out of the last 5 years, you do not have to pay taxes on gains of $250,000 or less if you're an individual, or $500,000 or less if you're a couple. So if I bought a house all out for $500,000 and sold it after living in it for 2 out of the last 5 years, if I sold it for $750,000, that'd be a $250,000 gain that I would not have to pay these capital gains taxes on. This is huge for me personally and has driven some of my decision making. When I bought my last house in Austin, Texas, I made sure that I was going to live there for at least 2 years. When I decided to move here to North Carolina, I really had to think about if I wanted to live here for more than 2 years. Especially because I buy houses that need a little bit of love, that need a little bit of remodeling like this here. So I'm increasing the value on these homes. I don't want to have to pay up a ton in taxes on all of that work that I put into these properties. If a property is not owner occupied, there are still some tax benefits you can get. This is typically for investors or vacation homes. These are homes where you do not live in the property 2 out of the last 5 years. So if you only live in a property for a year and a half, for instance. For properties that you own for less than 12 months, you are taxed at ordinary income. If you are fortunate enough to own a second home like this, you probably fall in a tax bracket of 20 to 40%. So if you were to flip a home, you buy it, you fix it up, and then you sell it a few months later, you will be paying your 20 to 40% of taxes on the capital gains. They don't show you that on those flipping HGTV shows. When they walk away with that $50,000 profit, they're really walking away with maybe $30,000 in profit. Although, again, there's other write-offs that they're probably accounting for. Still good money, but not even close to that $50,000. For properties that you don't live in, but own for more than 12 months, you are taxed at a flat rate of 15%. This is why I personally love buying investment properties, flipping them, but holding them for a year, renting them out, and then eventually, I haven't sold any of them yet, but then eventually sell them, and they will only be accounted for a 15% tax, a flat tax rate. I'm making cash flow now, and then eventually when I sell them, I'm gonna be taxed at a lot less than what my ordinary tax rate is. Let's go even deeper now with calculating gains, specifically with adjusted basis. Let's say I buy that $200,000 plus $10,000 of closing costs, like we did in the example earlier. Then I spend another $10,000 updating the kitchen. My adjusted basis is now $220,000. Just add up all the cost. Then let's say I sell that property for $305,000 now, minus my $12,000 closing cost, again from the example before. Then I subtract out the adjusted basis. My gain is now $73,000. Adjusted basis is just the total amount you have invested into that property. Real estate is considered an investment. The government gives you a large tax benefit just from owning real estate, especially for investors. It has been proven time and time again that the government does a poor job of providing government housing. So the government incentivizes people like you and me to provide this service for people to live in. On paper, a house depreciates every 27 and a half years. This is straight line depreciation. This means that on paper, for the IRS, your house structure is basically worth $0 at the end of 27 and a half years. This is a good thing. As an investor, I can write off that depreciation on my tax returns, and it is a huge write-off. And I keep saying on paper because when I eventually sell my house, it doesn't depreciate. The housing market in the long run always appreciates in most markets. When I sell my house in 27 and a half years, it'll be worth 5 times as much as it is right now, but on paper it'll be depreciating. Just think about the house you grew up in. It's probably $50,000. Now it's probably $200,000-$300,000. So I'm 100% not going to get political, and I'm 100% not going to say what is right and what is wrong, but I thought this was really interesting and it relates really well. There was an article that came out a few years ago about Trump paying $0 in taxes for 2 years back in the 90s, and there was a huge uproar over this, especially because Trump has not yet released his tax returns. Well, without diving in too deep, because nobody really knows what happened here except for Trump and his accountants, the spokesperson for Trump said, quote, "Welcome to the real estate business." This guy is a massive real estate investor, and as I've said before, real estate provides a large amount of tax savings where investors can write off large amounts of money. The first year I invested in real estate, I had a ton of real estate expenses. It was my first year. Startup costs are expensive. Well, I was able to write all of it off on my income that I made at a tech job, not having to do with real estate at all. This brings me to my last point. There is something called a 1031 exchange. This is where you own an investment property and you want to sell it. Well, if you just sell it normally, you'll pay capital gains taxes on any gains that you get. If you do a 1031 exchange, you basically just swap out your old investment property with a brand new investment property that is worth the same amount or more. You have something like 60 to 90 days to get this new investment property under contract by the time you sell that old investment property. You swap it out and you avoid paying those gains taxes until you eventually sell your new property. Or you can do another 1031 exchange from that new property to a newer property. And then again and again, delaying paying any gains taxes on that property your entire lifetime. Make your kids pay for it. And that's all there are to these taxes. I hope I made it clear to y'all. I actually love this topic if you couldn't tell because I feel like it's really overlooked, yet it's such a huge advantage to property investing. This chapter is way too short for a real review, but just know that there are huge tax advantages in how to calculate the gains on the property and what a 1031 exchange is. Listen, I really appreciate your time. I really appreciate you subscribing, and I really appreciate you giving this video a thumbs up. Thank you for watching another one on the North Carolina Real Estate Exam Prep. Up next is Chapter 19 on basic construction. Peace.